Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Rob Jankiewicz, Economic and Statistical Research Specialist with Nasdaq. Rob, it's great to have you with us. Welcome to Trade Talks.
Yeah, thanks so much, Jill. Thanks for having me.
Rob, how has the U.S. IPO market fared so far this year, and what's different about SPACs compared to traditional IPOs?
Yeah, that's a great question. And so far, 2021 has been a pretty strong year for U.S. IPOs. There have been around 720 new listings, raising over $200 billion worth of capital. And like you mentioned, one of the interesting trends that we see in 2021, which really started to pick up in 2020, has been the issuance of SPACs, or these are special purpose acquisition companies. And so really, we could just think of SPACs as just another way for private companies to come to the public markets. So generally what happens is we'll have sponsors issue what are called units, which really just represent cash held in trust, and they'll go out for perhaps 2 years searching for a private company to bring public. So really we can just think of SPACs as representing future IPOs or future operating companies that will trade on exchange.
What's a typical IPO process?
Yeah, so I mean, all new companies need money, whether that's to continue building product, to pay staff, or simply to expand the business. And so generally what will happen is new companies will go out on a roadshow, meet with institutional investors to pitch their business to, and underwriters will help determine the right valuation for the company. So the night before trading actually happens, the underwriters will determine the IPO placement price, which is really just a level where the company is able to raise enough capital and the level that also meets current investor demand. But the next trading day or the following day is when trading actually happens. And this is where the listing exchange helps determine the first trade price. And often what we see is that this first trade price and subsequently the closing price on that first trading day is much higher than the overnight placement price, giving way to strong first day returns, which we often refer to as the IPO Pop.
And Rob, what have first trading days looked like over time? Do all IPOs get that pop?
Yeah, that's a really great question. So on average, all the way back from 1980s to the present, the average first day IPO return, so this is from IPO placement price to the closing price on the first trading day, has been around 18%. And last year alone was around 38%, which is about the same this year. But one thing I'll note is that IPO pricing certainly isn't risk-free. In fact, around 30% of IPOs actually close lower on their first trading day than that IPO placement price. And that rate is pretty consistent over the past 10 years or so, even when we include the last 2 years of stronger first day returns.
Are there any factors related to IPO first day returns?
Yeah, so there's no perfect formula for what makes an IPO pop on day one, but there are some things that seem to help. So for one, the IPO placement price relative to the initial filing range seems to be a pretty good indicator of how that IPO will perform on day one. So for instance, if a company is priced at the high end of the range, they'll tend to experience stronger first day returns than companies that are priced at the low end of the range. And we also see that market momentum seems to help. So companies that IPO in a rallying market seem to do better than companies that IPO in a lagging market. And then finally, IPO float size. So really this is just the relative supply of additional shares of the company that are available to trade in the market. We see that smaller float sizes tend to have or help boost those first day returns.
Does profitability have anything to do with IPO returns?
Yeah, so that's a very interesting question, especially given the answer is pretty counterintuitive. We actually see that companies that aren't profitable at IPO are actually experience stronger first day returns than companies that are profitable. And so really, for me, this just shows how difficult the valuation process is, especially for IPOs. Because, I mean, fundamentally, when we think of valuation process, prices today are based off of future expected profits. And for IPOs, there is a lot of uncertainty that rests around those future profits. So it's definitely difficult. But one thing I'll mention, though, is that just because an IPO or a company isn't profitable today doesn't mean that it can't achieve profitability in some time in the future. For example, Amazon, everyone knows Amazon today, but when they IPO'd in 1997, they hadn't yet achieved profitability. But I mean, in terms of profitability and IPO returns, one thing that we do see is that the percentage of companies coming to market without earnings has been increasing lately.
And Rob, does this mean that companies are coming to market too early?
Well, we actually see that when we go back to around the 1980s and all the way to the present, the median age for IPOs, so new companies that list, has actually increased over time. So in the 80s and 90s, it was around 8 years old, and currently it's hovering around 10 years old. And I mean, the trend in rising unprofitable IPOs, or the percentage of IPOs that are unprofitable, I think this really could just simply reflect evolving market landscapes. It's difficult for new companies to gain market share and gain product adoption. And really, this could just be getting harder for new companies, especially as those existing companies grow larger and expand globally.
Yep. So, Rob, what does this mean in the long run? In other words, what happens after day one of the IPO?
Yeah, so price data show that as time passes, prices will adjust to reflect reality. And really, reality can be starkly different compared to those initial expectations around the IPO. So really, there's quite a wide range of performance. What we see is that around 2/3 of IPOs tend to not keep up with the rest of the market. But interestingly, what we do see is that those that are able to continue to grow revenues and meet those profit expectations do seem to earn outsized positive returns. So really, this data just show or highlight the importance of diversification for investors. But overall, as much as the market tries to pick winners on day one and value companies properly, the real returns happen over a much longer time frame.
All right, Rob, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.